Hi and welcome to a brief student loan marketplace update from GL Advisor. I'm John Collins, GL's Managing Director, and I'll be walking you through this short presentation. Today we'll talk about two main areas of interest. First, the folks in Washington have been creating quite a buzz lately, with President Obama signing a new executive order on student loans, Senator Warren of Massachusetts bringing a refinance bill to the Senate floor, and budget and banking committees holding hearings on the plight of student loan borrowers and the rising cost of education. Additionally, there's been some action in the private lending space that caught our attention, as competition heats up to the benefit of many qualified borrowers. President Obama would like to limit the monthly payments of all federal student loan borrowers to just 10% of their income. His executive order nearly accomplishes this objective. First, the Pay-As-You-Earn program, currently in place, allows borrowers of federal direct loans who had no outstanding student loan balance on October 1st, 2007, as well as a new student loan disbursement after October 1st, 2011, to make payments based on a small percentage of their income. Specifically, their monthly payment is limited to 10% of their discretionary income, a sum often dramatically less than the standard payment they would otherwise be required to make. On a month-to-month basis, this means that a single medical resident, for example, making $52,000 per year could save an estimated $156 compared to the other income-driven repayment program, income-based repayment, or IBR, if only they were eligible for pay-as-you-earn. The executive order removes the eligibility requirements tied to dates, such that any direct loan borrower that demonstrates a financial hardship is eligible for pay-as-you-earn. This order will of course take time to implement, and it's expected the Department of Education will make the changes effective in July of 2015. Important to note that outside the liquidity benefit described above, the Pay-As-You-Earn program also forgives borrowers of any remaining balance after 20 years of payments, a 5-year reduction in total term compared to IBR. In total, it's estimated that this change in eligibility requirements will impact roughly 5 million borrowers, seemingly providing the opportunity for hundreds of millions of dollars to be diverted back into the economy by young borrowers. The Warren bill, which was shot down earlier this week, attacked the perceived mispricing of federal education loan debt. Many recent graduates borrowed at rates higher than today's fixed rates and have no opportunity within the federal marketplace, that is, to refinance their debt at 6.8 or 7.9%. With current interest rates at more than 1% below these historic rates, many graduate borrowers could have saved tens of thousands of dollars over the life of their loan through the proposed legislation. To pay for the cost associated with reducing interest rates on billions of dollars of student loans, Warren and Senate Democrats propose to close tax loopholes for very wealthy Americans, in line with the often debated Buffett rule. This, along with some other factors, split support for the bill down party lines and helps explain why the effort was ultimately unsuccessful. The costs of higher education have also come under scrutiny, as recent data from the Bureau of Labor and Statistics and numerous think tanks concur that tuition has more than tripled over the past 3 decades. This rate of overall inflation during the period eclipses even the rise in healthcare costs the U.S. is currently battling to address. As such, some of the conservative pushback to Warren's bill focused on how the bill did nothing to address the rising cost of education, but rather provided simply a cheaper way for folks to finance the cost. Economists from both sides of the political spectrum have spoken in recent congressional hearings regarding the relationship between the availability of student loans and the rise of tuition. Most concur that there is a strong correlation between the two, and as such believe that the current proposals don't address the root cause for concern. Finally, we've seen a lot of activity in the private lending marketplace in the past few months. A number of new entrants have gained considerable market share by offering fixed rates as low as 3.5% to highly qualified borrowers. With Senator Warren's bill shot down and no existing alternative proposals to refinance federal student loans within the federal marketplace, Private banks, credit unions, and student loan lenders will continue to fill in the gap in what looks like a race to the bottom for at least the next few months. That's all for now. Of course, if you're interested in learning more about the programs discussed or the services we provide, feel free to register for a free assessment of your options at gladvisor.com/free assessment, or simply contact our analysts at 877-552-9907.